I know here at the Cash Flow Company, you were trying to make investing easier for people. What's one of the tools to do that we haven't talked about in a while?
It's going to be the HELOC. HELOC in investing is a key to making this just easier, faster, and getting into more deals, creating that wealth faster. But it's also opening up these lines of credit so they could either fund everything themselves or get deals under contract. Just the flexibility, everything that a HELOC does. It's crazy that all investors don't have a HELOC on one of their properties or all their properties.
Okay, so the benefits are so apparent that it's wild that more people don't.
Correct.
Don't have them.
The people who have HELOCs, who use HELOCs, who understand HELOCs, make their investing so much easier because they don't rely on money. I mean, we're a lender, and I'm talking about people who use HELOCs don't need a lender. They could just go scratch a check, something's at auction, or something comes up. They could be the cash buyers, the true cash buyers who get the good deals.
Okay, so let's start from the absolute basics then. What does HELOC stand for, and what is it?
So a HELOC, what stands for is home equity line of credit.
Okay.
Basically, it's a mortgage on a property. It could be an owner-occupied. It could be a rental property like a non-owner. It can be in first position, means you don't have any other mortgage on there. Or it could be in second position, which means you already have a mortgage on there, and it's going to be behind that mortgage. It's typically or never will be beyond second position, which means third or fourth, but it's usually a first or second. Okay. So if you own a property free and clear, you could use a HELOC. If you have a property that already has a loan or mortgage on it, you could get a HELOC also. What this allows you to do, it's just like a big credit card on your home that's mortgaged against your house, so you're putting up a property. But the reason you're taking that risk is of all the benefits. Let's say you have a house and it's free and clear. We see this with investors all the time. They own the house for $300,000 and they go out and get a HELOC for maybe $200,000. Or they have a property that is worth $400,000 and they owe $250,000 on it, and they go out and get a HELOC for $75,000 or $80,000. What that does is it allows them to use the flexibility of having money. Someone comes to them with a good deal, they could scratch a check if they had the $200,000 and the property's under $200,000. They could just go write a check out of that HELOC and pay for something. A line of credit, a HELOC, once you get approved, so you go to a bank, you go to a credit union, something local, you go through the HELOC process. The good thing about HELOCs is especially if you go to a credit union, it's little to no cost, maybe a couple $100 to get a HELOC. The drawdown period where it acts like a credit card is for 10 years. So for 10 years, you could use the money, pay it back, just like a credit card. Take out some money because you just found a deal and you got to put some money down, your earnest money, your down payment. Just go write the check, use it, you sell a property, pay it off, and use it again, just like a revolving line of credit. That's what it is. So it gives you the flexibility as an investor to, at any point in any time, to wire funds, to just write a check, because you take your HELOC and you have a checking account that's attached to it, so it would fund it. And in some cases, the really advanced banks will allow you to use a debit card. So you're on a project, you're fixing it up, you have repairs. You could use a HELOC for your down payment. You could probably even use it to purchase it. And then if it has a debit card function too, you could use it like a credit card to buy all your materials to fix it up. So you could use a HELOC instead of a bank or a hard money lender or a private lender to help you with all of these things, or at least to get your foot in the door on good deals, because you could write a check today or tomorrow. You don't have to ask me for permission as a lender. You don't have to go through underwriting. You don't have to go through appraisals, any of those things, because you have all the control once you set this HELOC up.
Interesting. And is one of the benefits the fact, is the interest rate lower? I know lines of credit are usually a lot lower than credit cards, for example.
Yeah.
Is it like that, where it's the interest rate isn't as bad?
So let's look at an example. So number one, a credit card could be easily in the 20s.
Right.
Since a HELOC is a lien, it's a mortgage on a property. Typically in this environment, you're looking at rates in the 8s to 9s. And hopefully as rates start coming down, those rates will go down with it too. So compared to a credit card, a lot cheaper. Compared to a private money, hard money, even a bank loan, they are cheaper. If you're paying anywhere between 9.5 and 11.5 for a private money or a fix and flip loan, let's call it, the interest rate here will be cheaper. But the big point is, once again, I have this $200,000 and I could buy a property for $200,000, or I have $1 million house and I get a bigger HELOC. For this example, let's just say it's a $200,000 purchase, rehab, and everything. I have a HELOC. I go down and take out my $200,000 to buy it, to fix it up, to finance the whole thing. And I'm paying, let's say, 9%. The things that I'm not paying for an appraisal. I'm not paying for points. I'm not paying for underwriting. I'm not paying for processing and any of the other mortgage policies that come with title and all these other things. I'm saving literally thousands of dollars on each deal, sometimes $10,000 to $20,000 in origination, in upfront costs, compared to someone who has to go to a lender. So even though it seems like it's counterintuitive for us to talk about something like this, it's a big benefit for real estate people who have the option to get HELOCs in the home they live in or the properties that they have.
Okay, so if I'm understanding, part of the reason there's such a benefit here is because of how complicated it normally is to get a loan, and this is just and costly.
Yeah.
And this is more simple and more affordable when you get a loan because of a lien on your existing property.
Yeah, where anytime that you could just decide you want to buy something, the ability to write the check or do the wire. So you as an investor find a property. It's a good property. It's $100,000. It's a great deal because it's worth $200,000. You as an investor could go like, okay, I'll buy it. I'll buy it as soon as you get title, because I could go to my bank, have them wire the funds without asking them permission or anything, because I've already set up my line of credit and they've already agreed to it. So I could go at any time, just go like, hey, I want to wire $100,000 for this closing, and it's done. If you're an investor and you have to go through a lender, the lender's going to ask for, give me the comparables, let's do an appraisal. You might be able to close in a week, but it's all the other things that you have to give up as far as time and money to pay for that. It's just so much easier if you have lines of credit.
Yeah, it sounds like it. Why do you think that HELOCs aren't as common as they could be?
Number one is people are confused by them. It doesn't matter if you're in the investing world or just a consumer owns a home. People are so confused on them and where you could get them. And the ones that are better for you. And it's also like, hey, maybe you only have one or two properties and maybe you can only get 40 or 50 grand out instead of 200. But that 40 or 50 might be your money for your down payment. So you can get a private loan and you can get a fix and flip done. Or it could be your monthly payments, which, for your fix and flip. This line of credit opens up so many doors. It does not have to be that big. And some people are like, well, if I can't get 200, why would I get 40? Because that 40 can take you and maybe get you into a second property, because now you have this pile of money over here that I could use anywhere in my investing world. Yes, I'm using my home, but if I could get a better return by using a HELOC than paying someone else like a private lender or something like that, if I could save 2 to 20 grand on each deal, that's just, you have to look at it the risk reward kind of thing.
Yeah.
And some people just look at it as like, I'm going to get the thing done anyway. Let me save 20 grand per deal. I do 4 or 5 deals a year. Let's call it 5 deals because it's just easy math. To save 20 grand, that's 100 grand someone saves by using these lines of credit over using private money.
Yeah, definitely. And like, how much is your time worth too on top of that? Like, you could save 2 to 20 grand per deal. And then also, how much time are you saving?
Yeah. So that's important, is setting up these lines of credit on your house, on your rental properties. Anything that you could do, and I think we've talked about this before, is like when the strategies, when you have rental properties, like if you have 4 or 5, when you're just starting out, focus on getting one paid down as much as possible.
Right, yeah.
Because you're freeing up equity in that one property. It's better than having, like 5 properties that you're slowly paying down. Your equity is not really growing that much. Instead of, if you have a little extra money, pay on those 4 as you go, but take one, pay it down so you build the availability for a HELOC, because you go from 80% down to 60% over a few years because you're paying down. Now you've freed up that equity. That equity can now be used for more properties. We have so many investors going like, I have all this equity tied up in my properties, but I can't use it. This is a way to use that equity.
Excellent. So you're saying to pay down one, and that would
free up some equity.
But I know you said before that you could have a HELOC on home with a mortgage. Is there a certain amount that has to be paid off in order to get a HELOC?
It just depends on where we're at in the economy. Again, great economies, they'll lend up to 100% of the value of a property. In uncertain times, it may go down to 90 or even 80%. So it just depends on where you're at. The beautiful thing about a HELOC is it's so low cost. Let's just say right now, you could only go up to 80% of the value. So I have a property that's worth $200,000. The HELOC will only allow me to go combine loan to value, which means the first I have and this new second up to 160, which is 80% of 200. Let's just say the economy gets better, and in a year from now, there's options for 90%. A HELOC costs me probably $250, sometimes $0 to refinance it. So get a HELOC at 80, and then if it gets any better at 90, go out and refinance that into a new HELOC. You'll have to pay off whatever's on that line, but you're freeing up more. So you could ride the curve up. Typically, if you work with the credit union or bank, they're not going to say, hey, I gave you 100%. I want to knock down this loan because things are going down. So you have some flexibility when it's going up to refinance it every year. Because unlike a first mortgage where it's going to cost you $7 to $10,000 to refinance, you're talking a couple $100.
Yeah, sounds like it. Sounds like HELOCs in general are worth it.
Yeah.
Or do you have any HELOC tools on the cashflowcompany.com?
Yeah, we have a HELOC questionnaire. So you just go to thecashflowcompany.com and there's a HELOC questionnaire that helps you run through like what's better for me, because there's different drop periods, there's different interest rates. Is it a fixed rate during this period or not? There's so many things that you have to look at for a HELOC. So there's just a little questionnaire that'll help you out.
Okay, and that's under tools, the drop down for tools there?
On thecashflowcompany.com.
Cool. Awesome. Well, thanks for explaining this today, Mike.
You're welcome. Thank you.
See ya.